Hi everybody, I wanted to provide an overview for Chapter 15, problems 1 through 4. So this is going to be kind of a general overview, and then what I want you to do is watch this video, pause along the way, and we're going to go over some concepts that you'll need in each of the problems 1 through 4, okay? So let's start out with, I have problem number 1, kind of the facts for that, and I'm going to build off of problem number 1, okay, to kind of like build into the other homework problems. So we have a $300,000, let me read the actual problem here. Sheridan Inc. issues $300,000, 10-year, 9% bonds at 95. Prepare the journal entry to record the sale of these bonds on March 1st, 2020. So we need to have a journal entry, so we need to have some accounts and some debits and credits, okay? So this is not new. The journal entry itself is something that you already know how to do, but of course the question is, what account titles do we use and what are the amounts? What are the figures that we need here? And that is new. What we need to do, the first thing is we need to unpack this language, and we need to remember that a bond is a form of debt. So this corporation has a need for $300,000 worth of cash. So what they're doing is they are selling little bond certificates, okay? So imagine getting this in the mail. And you are going to become a creditor of this corporation. You're going to buy one of these bonds. So you'll get a $1,000 bond with a 9% rate printed on it, okay? And you are one of 300 people who gets one of these $1,000 bonds. $1,000 bonds times 300 equals the $300,000 bond issuance. Okay, that's where the big $300,000 comes from. But it is important to note that at the other end of this transaction are people who are purchasing the bonds, and these people are creditors. They are effectively giving cash to the corporation so that the corporation has cash. These people will be paid back, and they're also going to get some interest. Now, we'll look at the interest in a moment. For now, let's look at we just looked at $300,000, 10-year, 9%. Actually, a 10-year, let's look at that. The idea here is that this bond is going to have a life of 10 years. So at the end of 10 years, the corporation is going to have to pay the bond back. Okay, the bonds will be retired. They'll get to their maturity date at the end of 10 years, and they will no longer be in the bond marketplace. Okay, so this is debt. This is like an account payable, a note payable. It's the company getting access to cash, and they're doing it through creditors who are lending money. Okay, okay. So $300,000, 10 years, 9%. Really important to remember the 9% is stated on the bond. We're going to get to that in a second. So these bonds are sold at 95. Well, what does that mean? What that means is that they are sold at 95% of their value. So we have a $1,000 bond, and I'm just going to use 1,000 for now, just to keep the number simple, times 95%. You can do 0.95 or 95 and then the percentage, and you get $950. Okay, what this means is that the corporation was able to sell this bond not for the full $1,000. This customer wasn't willing to spend the full $1,000. This customer was only willing to spend $950, and the corporation was willing to make that deal. Now, why would this happen? Why not just sell it for the $1,000? Because of this interest rate. This interest rate of 9% is not as competitive as other bonds in the marketplace. This interest will factor into the interest revenue that this person is going to be able to make. Okay? So this person wants interest revenue. That's one reason they are purchasing the bond. The higher the rate rate of interest revenue that this person will make. So the 9% is looked at as kind of not as valuable. So that's why it sells at 95. Now, quick logistical note, because it's important for context. When the corporation does a bond issuance, they literally will kind of do the issuance, and the 9%, I want you to think about that being printed on each bond certificate. Okay? So that is kind of like a stated, it's printed, and then it doesn't change. What does change is the market rate of interest, and that's why bonds will sell at a discount or at a premium, and sometimes they'll sell for their face value. In this case, because the number is less than 100, it's deemed to be selling at a discount, okay? This is just like going into the mall and buying a pair of jeans or a blouse at a discount, okay? You're not paying the full price, you're paying a discounted price. And the person selling it is willing to sell you at that discount because they want to sell this corporation wants to actually sell its bonds. So, Let's move away from kind of the personal perspective and look at this actual $300,000. What we want to do here is we want to look at what is 95% of $300,000. And the answer is, and I want you to do the math on, you should be doing your math on your end and writing these numbers out, is $285,000. So this corporation is going to get access to $285,000 of cash. Okay? That's how much cash they're actually going to be able to collect from this bond issuance. That's what these facts are telling us. This initial set of facts is telling us. Okay? We'll get to the 100 and the 105 in a second. The bonds are sold at a discount. So $285,000 of cash. Now, the actual liability is going to be called bonds payable. This is a new account title. And this is going to be actually $300,000. So the full amount of the issuance. Now notice we have a disconnect here. We have the amount collected in cash versus the amount of the payable. Now the payable is always going to be the amount that has to be paid back. Okay? And that's why it's the full $300,000. And we're going to use our journal entry skill set, and we know that debits and credits have to balance. So we need a $15,000 amount here as a debit, and this is going to be called discount on bonds payable. Okay? And I apologize, I'm kind of scrunching my letters up here. Let me do that. Discount on bonds payable. Okay? So the idea here is they have the liability to pay back the full issuance of $300,000, okay? And again, imagine 300 certificates, $1,000 each. That is the amount that they must pay back at the end, okay? But because they're choosing to sell it at a discount, customers, or creditors, I should say, are only paying 95% of the value. So they're only actually collecting the $285,000 in cash. So we have to reflect the amount actually collected in cash, the amount of the liability, and the related discount. The discount on the bonds payable is what we will call a contra liability account. Okay? It's a contra liability account. Let me write that down. This is similar. Remember we looked at a contra asset, right? We've seen contra assets before. Contra asset is, for instance, accumulated depreciation, if you remember back in Principles 1. This is called a contra liability. And what it does is it's linked up with the bonds payable. Okay, so this discount is really a cost to the organization, but it's a cost they're willing to take on. Just like when you go into the mall and someone puts a pair of jeans on discount, they want to sell those jeans. They want the jeans to move out of the store. This corporation wants access to at least $285,000 of cash, and they're willing to do this kind of deal with the bond market in order to effectuate that. Okay, so that's a discount. A premium would be similar. A premium is going to be, we're going to have to kind of reverse debits and credits. A premium means that someone is willing to spend more than the face amount because our rate of interest is more attractive than what is in the marketplace. So if we looked at a 300, let's take a look at the 105. If we took $300,000, and I'm going to erase this amount down here, we could do the math like this. 1.05 is $315,000. Okay, in this case, what we would have, we'd have something that looks like this. $315,000 of cash. Still, we would have a bond payable of only $300,000, so that doesn't change. And now what we would have is a premium on the bonds payable of $15,000. So this discount and premium kind of swings back and forth depending on, if the bonds sell at a discount or a premium. We really need to have a good grasp of debits and credits, and we need to just remember bonds payable is a liability, and we're getting access to cash, which is an asset.